a bank that nearly collapsed in 2020, rescued by the RBI in one of India's largest financial interventions, is now trading at over 700 billion rupees in market cap. So what's really happening with Yes Bank, and why are investors watching it so closely in 2024? Welcome back to the channel. Today we're diving deep into Yes Bank, ticker symbol YesBank.ns, one of the most dramatic turnaround stories in Indian banking history. Currently trading at around 22.94 rupees per share, with a market capitalization of approximately 718 billion rupees. This stock has been through an incredible journey. Whether you're curious about the banking sector, studying corporate turnarounds, or simply want to understand what makes this stock so polarizing among market observers, this analysis is for you. Let's break it all down with real data and context. To understand where Yes Bank stands today, we need to quickly revisit its past. In March 2020, the Reserve Bank of India orchestrated a rescue mission after the bank's capital adequacy ratios fell dangerously low due to massive non-performing assets. State Bank of India led a consortium of banks to infuse capital and prevent a systemic crisis. Fast forward to 2024, and the narrative has shifted considerably. The bank has been working methodically on cleaning up its balance sheet, reducing bad loans, and rebuilding depositor confidence. Reports indicate that the bank's asset quality has shown improvement, with gross NPA ratios trending downward compared to the crisis peak. The management team has focused on retail banking expansion, digital transformation, and building a more diversified loan book. Industry observers have noted that the bank's deposit base has stabilized, which is crucial for any lending institution's long-term health. In the current financial services landscape, Yes Bank operates in an intensely competitive environment. The Indian banking sector has seen consolidation, rising fintech competition, and evolving regulatory requirements. What analysts have been watching closely includes the bank's progress on capital raising efforts, potential strategic partnerships, and its ability to grow its retail and SME lending portfolios profitably. The financial services sector in India continues to benefit from credit growth driven by infrastructure, spending, and consumer demand, which provides a supportive macro backdrop. The bank's PE ratio currently sits at approximately 20.45, which reflects market expectations about future earnings growth. For context, this valuation needs to be compared against both historical averages and peer banks to understand what the market is pricing in. Recent quarterly results have shown the bank maintaining operational stability, though the path to consistent profitability growth remains a work in progress, according to various analyst commentaries. Now let's examine the challenges and risks that market observers frequently highlight. First, legacy issues. While the bank has made significant progress, the overhang of past problems, including stressed assets and reputation damage, takes time to fully overcome. Rebuilding brand trust with corporate depositors and customers is a multi-year process. Second, competition. Yes Bank faces fierce competition from both established private sector banks like HDFC Bank, ICICI Bank, and Kotak Mahindra, as well as aggressive public sector banks and new age fintech players. Gaining market share in this environment requires substantial investment in technology and distribution. Third, interest rate sensitivity. Like all banks, Yes Bank's net interest margins are influenced by RBI's monetary policy decisions. Rising or falling rate environments affect lending profitability differently. Fourth, capital requirements. Growth in the banking sector requires adequate capital buffers. How the bank manages its capital raising and maintains regulatory ratios will be closely monitored by market participants. Finally, execution risk. The management's strategic plans need consistent execution over multiple quarters to translate into sustainable financial performance. Let's look at the current numbers. Yes Bank trades at approximately 22.94 rupees per share, showing a gain of about 1.91% in recent trading. The market capitalization stands at roughly 718 billion rupees, making it a significant player in the Indian banking landscape. The price-to-earnings ratio of 20.45 suggests that the market is factoring in expectations of earnings improvement. For banking stocks, analysts also typically examine metrics like price-to-book value, return on assets, return on equity, and net interest margins to get a complete picture. The stock has shown considerable volatility over the years, which is characteristic of turnaround situations where sentiment can swing based on quarterly results and news flow. Trading volumes remain healthy, indicating continued market interest in the name. From a technical perspective, the stock has traded in various ranges, and chart watchers often look at moving averages and support resistance levels to understand price behavior patterns. Now, let's explore potential scenarios over 1, 2, and 5-year horizons. Remember, these are analytical frameworks, not predictions. In an optimistic scenario, the bull case, the bank successfully completes its transformation. Asset quality continues improving, deposit growth accelerates, and the bank gains market share in profitable segments like retail and SME lending. Digital initiatives drive operational efficiency, and the bank achieves return on equity comparable to well-run private sector peers. In this scenario, the valuation could potentially re-rate as the market gains confidence in sustainable profitability. In a base case scenario, the bank makes steady but gradual progress. Profitability improves incrementally, but competitive pressures limit market share gains. The bank maintains adequate capital and liquidity, and asset quality remains stable. Growth matches the broader banking sector without significant outperformance. This middle ground scenario suggests the stock could track sectoral trends. In a cautious scenario, the bear case, macroeconomic headwinds like rising defaults or economic slowdown stress the loan book. Competition intensifies, squeezing margins. The bank struggles to grow deposits at competitive rates, or legacy issues resurface. In this scenario, earnings recovery could stall, and valuation multiples could compress. What factors would influence which scenario plays out? Key variables include overall economic growth, RBI's monetary policy trajectory, the competitive dynamics in Indian banking, management execution, and any potential strategic transactions or partnerships. Market observers will be watching quarterly results closely, particularly trends in net interest income, provision coverage, slippage ratios, and deposit growth. So what did we learn today? Yes Bank represents one of the most significant corporate turnaround attempts in Indian banking history. The data shows a bank that has stabilized from its crisis lows, with a market cap of over 700 billion rupees and a PE ratio suggesting growth expectations. However, the journey is far from complete. Competition remains intense, execution risks persist, and the banking sector faces its own cyclical challenges. The stock's volatility reflects this uncertainty. For anyone studying banking sector dynamics, corporate turnarounds, or Indian financial markets, Yes Bank offers a fascinating case study in crisis management, regulatory intervention, and a long road to rebuilding institutional credibility. If you found this analysis valuable and want more data-driven breakdowns of Indian stocks, hit that like button and subscribe to the channel. Drop a comment below telling me which stock you'd like me to analyze next. Your engagement helps this content reach more people who want to learn about the markets. For educational purposes only, not investment advice.